podcast today, and what we're looking to do today is to try and give you guys out there some ideas as to perhaps what we think might happen in 2024. So for some of you who might take some time off over Christmas and the New Year to evaluate your portfolios, today I'm delighted to invite Nathan Sweeney from the Marlborough Group to spend some time with us discussing his thoughts on the markets. And we've got some specific questions for him, which I think our audience will find interesting. So Nathan has been with Marlborough for 3 years, but he's been in the business for 24 years. And he manages a whole range of funds for Marlborough, which we can go into in a bit more depth later. But first of all, Nathan, thank you very much for putting some time aside to chat with us. And how's things with you?
Thank you for inviting me today. Everything's good. So yeah, it's a lovely sunny day here in London.
Excellent. Okay, well, look, let's start this by asking the sort of big question, I guess, that a lot of people will be thinking about is that as we turn our thoughts to 2024 and we read all these magazines and newspapers about what's going to happen in the markets in 2024, be interesting to get your perspective and your thoughts from a fund manager's point of view as to how you see 2024 panning out.
Yeah, so it's interesting you mentioned, what's in the media, because I think that can have a big influence on how people think about markets. So if we just take a step back and think about 2023, so coming into 2023, a lot of people were cautious about markets, and ultimately things have turned out better than people expected. So I do think that as we move into 2024, we're going to see a similar level of caution, and there's a couple of reasons why I believe that people are going to be a little bit cautious as we move into 2024. So firstly, and quite importantly, 2024 is going to be one of the biggest years in history for elections. So 76 countries around the world will be going to the polls in 2024. That represents over 4.2 billion people who will have the ability to cast a vote. And that's over 50% of the world's population. It represents 60% of global GDP. So if we're thinking about the media will be in a frenzy next year, focused on all of these elections. And to me, obviously, it's one of those things which can distract people from making good investment decisions. So I think it's quite important to highlight that up front and not to try and read too much into it, because ultimately you'll have a lot of political parties promising X and Y. They tend not to deliver on those promises. They can move the markets in the short term when they talk about them, but in the long run, they tend to have very little impact on the direction of markets. So again, I would try to avoid reading too much into any of the noise that comes with that, particularly in the media. Secondly, I think the other thing which has the potential to distract investors next year is the fact that there's going to be a lot of talk about slowing economies or perhaps even recession. So we do think that economies slow in 2024, but only modestly. So we don't think it has a dramatic impact. And clearly markets are already anticipating a slowdown of sorts. And that's why markets sold off so much last year, because we had inflation and high interest rates then to tackle that, which slows the economy. So I think there will be a lot for investors to try and avoid from a media perspective, because the key or the art to investing is about focusing on logic and reasoning and not the emotion which media tends to bring us all into. So I think if we focus on the logic and reasoning piece, I think that bonds look very attractive. So fixed income looks very attractive because we do expect to see big movement on interest rates next year, and that's likely to be quite a good backdrop for bonds. And we also think some of the areas which are interest rate sensitive will do a lot better next year as well. So areas such as smaller companies tend to find it challenging when interest rates are high, And if you see interest rates coming down, that tends to benefit smaller companies.
Okay, well, look, thanks a lot for sharing those insights, Nathan. I mean, I think I'd agree with you. And I think from our audience's perspective, I think it's also important what you said about media, because obviously, as we know, the media just focus on what's happening today or tomorrow, because their job is basically to sell newspapers. Whereas I guess the difference from an investment perspective is that, our investors and clients are looking more over a longer period of time. And I think that's why what you said about the media, it's really important for people to grasp that, because often I'll get emails or calls from clients who are distressed about what's going on because of exactly the reason you said, what they're reading in the media. So I think that's really a very valid point, and thanks for sharing that. You've touched a little bit, obviously, on some of the opportunities that you see, particularly in sort of bonds and fixed interest. But from an equity perspective, where do you also see the opportunities in 2024? So what will you and the guys at Marlborough be particularly focusing on?
Yeah, so I think if you look at 2023, we've seen that the market has been what they say is they call it narrowly led. So there's been a few companies driving a lot of the growth in some markets, particularly the US. So the Magnificent Seven, great technology companies. And, if you kind of step back and think about it, we use these technology companies every day. So you can see why they're so successful. Now, a lot of people are concerned about the fact that they have performed so well this year. And then the question is, can they continue to perform as well? So for me, it's more of a, will we see the rest of the companies playing a bit of catch up in 2024? And we think the answer to that is yes. And the reason behind that is because if we see inflation coming down, which it has been, and it's getting to really manageable levels now, that opens the door for interest rate cuts. And it means that these companies can then perform better, because one of your biggest costs is your cost of finance as a business. And if your cost of finance reduces, then that leads you to enjoying more profits, and therefore your share price rises. So for us, we think 2024 is going to be the year where we see a lot of catch up from a lot of other regions. We still believe tech will perform well, but it won't perform as well as it did in 2023. And relative to other areas of the market, you're not going to see that big divide. So we think 2024 is all about a bit of catch up, particularly for smaller companies.
Okay, that's interesting. So really what you're saying is that hopefully as we see inflation potentially continuing to go down or move down, and maybe interest rates also going down with that trend, there are opportunities in other sectors rather than just the big seven in tech. And what you're saying is that for smaller businesses, the reduced cost of financing will have a big impact on them, and hopefully give them greater opportunities to grow and progress. And in terms of, let's just chat a little bit more about interest rates as well. I mean, how do you see US rates in particular panning out next year? I mean, when do you guys anticipate that we'll start to see cuts? And obviously that then will highlight to the market that we are on a different trend downwards, as opposed to the trend that we've seen, in the past 18 months or so, where we've seen, fairly quickly, rising interest rates, as it were.
Yeah, so a couple of things to highlight there. So firstly, we've seen all major central banks stop raising interest rates. So that's the US Central Bank, or the Fed as they call it. They stopped raising rates at the back end of the summer of this year. We've also had the ECB, the Bank of England. So lots of central banks around the globe have been raising rates throughout the course of last year and this year. And now suddenly they've decided, actually, we think we have inflation under control, and therefore we don't feel the need to increase interest rates from here. So we believe that central banks have finished their interest rate rising programs because of the progress that they've made on inflation. Now, the second thing to point out is that next year will be that big political year, and you have elections in the US. And therefore, from a political perspective, will there be the will to keep interest rates higher for longer in an election year? Because if you have interest rates higher, that could lead to a recession. It could lead to job losses. And ultimately, that's not good for votes. So I do think that there will be a lot of political pressure on central banks to make progress on interest rates, because clearly we've made really good progress on getting inflation down. So now they'd like to see, actually, let's get those interest rates down too. The other interesting thing to point out is that central bankers over the course of the last 2 years have been talking about tackling inflation, raising interest rates. And we had an interesting development a couple of weeks ago where one of the governors, or the members of the central bank Fed, so the decision-making committee who decides on what they do with interest rates, they came out and they said, look, we think we've made real progress on inflation, and therefore we see the fact that we'll be cutting interest rates next year. So that's a real change in direction. That's a kind of a pivotal moment. It's the first time that somebody's openly come out and said this. And following that, a number of the other central banks have now done the same. So for us, we think we move to a period where we see interest rates coming through next year. And if we look at what the market is expecting, because ultimately you have a tug of war when it comes to deciding what happens with interest rates. You have the people who decide on that, so the central bank, and they say, look, this is what we think will happen. On the other side of that, you have the market. So, the market is trying to guess what will happen with central banks. And at the moment, the market is guessing that we start to see interest rates coming as soon as March of next year in the US, because the market is saying, look, inflation is now 3%. The central bank's target is 2%. We're nearly there. So why do they need to keep interest rates as high as they are? So I do think that the market is applying a lot of pressure on central banks to do something, but I think they're also going to get a lot of political pressure too. So for me, it's not a question of if interest rates fall, it's a question of when they fall. And I think it happens sooner than people expect.
Okay, well, look, thanks a lot for sharing that as well. I mean, as we've already discussed, you've been in the fund management industry for a long time, and it would be interesting for our audience maybe to get your thoughts. Maybe you can just take your Marlborough hat off here for a while. That if you were a personal investor yourself, where would you be seeing the opportunities to invest? But perhaps if we can look at maybe from a balance perspective, and for clients who are perhaps looking to get higher returns. So if we do see sort of interest rates come down, as we know generally that is a good environment, as we've already discussed, for equities. So if you're a mature investor, where do you think the opportunities are? What kind of funds or investments you should be looking at? And if you're more of if you've got a longer time horizon and you've got a greater appetite for risk, potentially, where do you see even better opportunities?
Yeah, so I think, from my perspective personally, my own pension, I invest that into a balanced fund. So the reason for that is several fold. So what you tend to find in markets is that different asset classes or different regions perform at different times. So in any given year, you can have one market up a lot and another market maybe not doing as well. Good example would be if we look at the US this year, it's had quite a good year. But if we look at it last year, it had quite a poor year, whereas UK equities, as an example, did well last year. So this is one of the reasons why a lot of people would advocate looking at a multi-asset or balanced portfolio that gives you exposure to different regions around the globe, because those different regions are doing different things at different times. And things can happen. Clearly, you have risks that pop up, and that creates volatility, and that might affect a specific region. And if you're in a diversified portfolio, it gives you that protection because ultimately you've got other investments. So I think from my perspective, with a long-term mindset, I'm always looking to invest in something which is giving me that balance, because you're also getting exposure to other things, not just equities. You've got exposure to government bonds in there. And I do think that's an area which is likely to do well, particularly if interest rates are coming down. So I like having that, formula within the multi-asset portfolio too. But, I think if you're a investor who's looking to take on a little bit more risk, or you've got a higher risk appetite, one area which is oversold is definitely smaller companies. Because if you imagine, if you're a smaller company, usually you need financing to grow. And when you have higher interest rates, banks then question, okay, if I'm going to lend money to this smaller company, I need to be sure that that smaller company is able to operate in an environment of higher interest rates where maybe they're selling less. So normally when interest rates go up, you see that banks stop lending to smaller companies. And because the market knows that, you tend to find that the share prices of smaller companies fall in an interest rate rising environment. Now, if we see interest rates being cut, then the opposite happens. And what we can see is that the share prices of a lot of smaller companies look very depressed. Now, the art in investing is clearly trying to buy low and sell high and not the opposite. And that's one of the key things that a lot of retail investors get wrong, because they get spooked about the news and decide to sell. But the market is possibly lower at that point when actually they should be buying. So for us, we think that there's a lot of value in small cap at this point in time. And ultimately, if you're somebody who's willing to take on that additional risk, then that's an area I would be looking at today.
Okay, thanks again for that, Nathan. I guess one of the other things, the big changes that we've seen in the last 3, 4, 5 years is the breakdown in the relationship between the US and China. And probably for the past 2 or 3 decades, I think it would probably be fair to say that the globalization has helped to bring interest rates down around the world. And now that obviously you guys see this change in the relationship between the US and China, and we see the world dividing into different, sectors, as it were, do you think this will mean that even though interest rates might come down next year, they may not come down to what we've been used to in the past decade or more because of the geopolitical tensions in the world? I mean, how do you see that playing out?
Yeah, so I do think that's a factor. And I think there's other factors at play too. So over the last decade, we have had interest rates at uber low levels. So ultimately money has been free. It was so cheap to borrow. Are we going back to that world? I don't think we are. And I think geopolitics is one of the reasons why, because ultimately geopolitics has the potential to increase cost of goods. Transporting goods from China to the US, that's more difficult if you have, tariffs in place. If you have a trade war, it just adds additional cost. And if there's additional cost baked in, then that can create inflation. Now, because we've had substantial inflation over the course of the last 2 years, call it, it means that central banks are going to be very vigilant about inflation from here on out. So what they won't want to do is they won't want to drop interest rates back down to really low levels in case that creates inflation again. So you should expect them to reduce interest rates from here, because obviously they are high relative to the level of inflation as it continues to fall. But what they'll do is they will look to reduce interest rates down to a level which has historically been in place over the long term, which tends to be 2 to 3%. So that's where we think we get to. Now, what could cause them to do something that differs from that? Now, if you were to see a substantial pickup in inflation, then they might have to keep rates higher. Or if you were to see a big sell-off in markets, then they might actually lower interest rates. But perversely, that would be really good for equities, because you would have a cheaper cost of financing for companies, and you would likely see quite a strong rally in equity markets. So often what you expect to happen when you read the media doesn't tend to play out in markets, because markets are always looking forward for the opportunity, particularly when you have events happening. So I think the other thing to watch out for next year is, I mentioned elections and geopolitical risk. One of the first elections we have is in Taiwan. So ultimately, that's an area where both the US and China have an interest in that region. So I think that's likely to feature quite heavily. And then you have elections in the US. And what will that mean for the relationship with China? Because it will depend on who gets into power. If it's Donald Trump or if it's Joe Biden, how will they view that relationship with China? So as always, there's always something for markets to be concerned about, but generally equity markets are not necessarily looking into that too much. They're focusing on things like interest rates and what that means for companies financing.
Okay, thanks for that. I mean, apart from obviously the obvious tensions between China and the US, there are a few other things going on in the world at the moment, like the war in Ukraine, and obviously the issues in the Middle East as well. Do these affect your investment decisions at all, either negatively or positively?
Yeah, so I think we always have to assess what's happening in those regions and to see how it will impact markets, if at all. So if we look at Ukraine, clearly that had an impact on supply chains. It had an impact on supply chains of gas, oil, grain, and that did add fuel to the fire in terms of inflation. So that was something which a lot of people did react to in terms of their positioning, because people will have reduced risk in that inflationary environment, and portfolios did change as a result of that. With regard to the tensions in the Middle East and the conflict we're seeing there at the moment, clearly that has the potential to spill over into a wider regional conflict, and that would be bad for oil ultimately. And you should expect to see an oil price spike if that were to happen, and that could fuel inflation. Now, the reason the oil price has come down since the beginning of that conflict is because we haven't seen that happen. And therefore, the concerns about inflation that people had several weeks ago when this conflict began, those concerns have now dissipated. But there are ways to mitigate that. You can increase allocations to areas like gold, which you can use as obviously a hedge or something which will tend to do well when you have those periods of conflict.
Okay. Thanks for that, Nathan. Well, look, I think that was a really useful insight into what you see happening in 2024, especially, the impact of interest rates and all that kind of stuff. Are there any final thoughts that you'd like to share with our audience with regard to 2024 and this sort of holiday period? Are you expecting a bit of a Christmas rally into the new year, or in the sort of nearer term? How do you see markets playing out?
Yeah, so I do think you do tend to get that Santa rally, and that's a lot of people positioning before you move into the next year. So, the Santa rally basically represents the performance of the stock market between Christmas and New Year. So it's those couple of days. And, they tend to be positive because people are thinking, okay, what do I expect to happen in 2024? I want to take advantage of that, so I need to position for that today. And then the other thing I'd say is that, there are always things to be concerned about, and that often means that people miss out on the beginning of a bull market, because, that path up that mountain climb, for that bull market, the foundations for that are being laid today. But it's difficult to see that when you have all of this media noise and geopolitical tensions. But ultimately, the focus should be on central banks and what they're doing with interest rates, because that's the biggest driver of company profits. And that's what the market will be focused on. And because inflation is coming down, we can see that interest rates are going to fall. And if you take that into consideration, that to us is very positive.
Okay, excellent. Well, Nathan, thanks a lot, as I said, for your time today. Really appreciate the opportunity to chat with you. And I think our audience will find it really relevant as well, because as you say, with all the noise in the media at the moment and what's going on in the world, sometimes it's hard to separate this from the reality of the markets. And I think from what you've been saying today, clearly, although perhaps the last year or so hasn't been so good for equity markets around the world, or for the majority of funds and stocks, we are potentially, seeing some much better opportunities in 2024 for, equities and bonds as well. And especially if we can assume that interest rates in the US will go down, as you maybe highlighted. And clearly, if they go down earlier rather than later, that can only be a positive for both bonds and equities. So, yeah, thanks a lot, Nathan. Really appreciate your time. And I hope our audience found that interesting, and we'll look forward to doing more podcasts in the future. So bye for now.
Thank you.
Okay, cheers, guys. Thank you very much for that, Nathan. Lance, you can turn the recording off now, if that's okay. So.